Buckle up, fellow tech enthusiasts. In today's Monday edition of the Tech Stocks Daily podcast, we're diving headfirst into a sea of groundbreaking developments from the Nasdaq's tech titans. From Google's jaw-dropping commitment to delete billions of data records post-lawsuit, to Microsoft shaking the tech and regulatory worlds by unbundling Teams from its Office suite. Snowflake's facing turbulence with bearish bets and legal storms, while Apple navigates through slowing iPhone sales with resilience. Palo Alto Networks stands at a crossroads, dealing with bearish sentiments and mounting legal challenges. These stories are not just updates, they're the tremors reshaping the tech landscape. So stay locked in as we unravel these tales and forecast the potential ripple effects across the tech sector. You won't want to miss this roller coaster of insights and analysis. In a landmark turn of events, Google, a tech behemoth known globally for its Chrome web browser among other services, has agreed to delete billions of data records tied to its Chrome users who have surfed the web in what they believed was the privacy of Incognito mode. This decisive action comes as part of a sprawling settlement in the wake of a lawsuit that accuses Google of misleading users about the privacy of their online activities when using Chrome's Incognito mode. Dating back to June 2020, the lawsuit spotlighted Google's privacy practices, charging the company with unauthorized tracking of users even when they had toggled on the supposedly secure Incognito mode. Chrome users initiated this legal action believing their privacy was ensured, only to discover that Google could still technically observe their online activities. After a series of legal challenges, including an unsuccessful bid by Google to quash the lawsuit, the settlement terms unveiled shed light on not just the deletion of a colossal trove of personal data, but also a series of commitments Google will undertake to enhance user privacy awareness and control. Central to these commitments is Google clarifying its data collection practices more transparently to users each time they activate Incognito mode. Additionally, Google has consented to implement a default blockade of third-party cookies in Incognito sessions for a stipulated 5 years. Cookies, which websites deploy to collect data on its visitors, have been a significant gripe among privacy advocates, who argue they can track users without explicit consent. Though the disclosed settlement did not award financial damages to Chrome's millions of users represented in the class action lawsuit, the proceedings have drawn significant attention to digital privacy and Google's obligations towards its users. Legal commentators pointed out the potential far-reaching implications of such a settlement on the tech industry's data handling and digital surveillance practices. Further broadening Google's courtroom challenges, the tech giant also remains embroiled in regulatory battles, including a closely followed antitrust lawsuit concerning its alleged monopolistic practices in the digital ad domain. Alongside, Google's valuation of its privacy-focused settlement between $4.75 billion to $7.8 billion starkly underscores the high stakes involved, emphasizing the prominent role user data plays in Google's revenue model, stemming mainly from digital advertising. This sweeping settlement distinctly showcases a growing reckoning within the tech industry regarding user privacy. As both consumers and regulatory bodies push for stricter oversight, the fallout from Google's decision could potentially shape future digital privacy norms, compelling tech companies to reassess their user data practices more scrupulously. Microsoft grabbed headlines today with a significant strategic shift that resonates across the tech and regulatory landscapes. In a move shaped by antitrust concerns and regulatory pressures, the tech titan announced its decision to unbundle its popular communication and collaboration tool Teams from its Office suite of productivity applications globally. This decision marks an extension of a strategy first adopted in the European Economic Area and Switzerland last year, in response to investigations and concerns from the European Commission over potential anti-competitive practices. At the heart of the matter is the way Microsoft integrates Teams with its Office 365 and Microsoft 365 subscriptions, a tactic that has drawn scrutiny for potentially stifling competition in the communication software space. Competitors like Slack have voiced concerns, leading to formal probes and raising questions about the fairness of Microsoft's bundling practices. The company's capitulation to regulatory pressures represents a nuanced acknowledgement of the evolving expectations around technology provision and competitive conduct within the global marketplace. For enterprise customers, this shift promises more flexibility and choice, enabling them to select Office applications without the mandatory inclusion of Teams, potentially at a reduced cost. This unbundling is designed to foster a more competitive environment, benefiting not just consumers but also other players in the communication software industry, albeit with a cautious note from analysts about the extent of this impact given Teams' already vast user base and aggressive pricing strategies. This move also reflects Microsoft's broader strategy to adapt and thrive amid increasing global scrutiny of big tech firms' market dominance and business practices. By proactively addressing antitrust concerns, Microsoft not only aims to avert potentially hefty fines and further legal battles, but also to position itself as a responsible and responsive market leader in an era demanding greater corporate accountability and openness to competition. Today's announcement underscores not just a tactical business adjustment, but a strategic pivot that could influence the broader tech ecosystem, setting precedents for how software giants navigate the complex interplay of innovation, market dominance, and regulatory compliance. In today's tech news orbit, Snowflake sashayed into the spotlight, not once, but thrice, painting a somewhat tempestuous portrait of the data warehousing heavyweight. Kicking off the drama, we unearthed some eye-opening options activity, indicating a valley of bearish bets against Snowflake, suggesting that some investors with deep pockets and potentially deeper insights are bracing for turbulence. This financial maneuvering conjured a mixed bag of sentiments, with a noteworthy tilt towards the bears, sparking whispers and side-eyes about what these moneyed movers know that we don't. Adding a more direct narrative to Snowflake's stormy day, an analyst from Redburn Atlantic drew his sword, slashing Snowflake's stock rating to a sell. The forecast? A chilling high-stakes bet against the company, underpinned by a stout belief that market expectations are skimming the clouds, far detached from the gritty reality on ground. This frigid reception was largely fueled by Snowflake's perceived shortcomings in hitching onto the generative AI bandwagon, a blazing hot sector that's quickly becoming a battlefield of technological supremacy. The plot thickened with not one, but two legal thunderclaps seeking accountability for alleged overexuberance. Glancy Pronge and Murray LLP and Levi and Korsinski LLP have both sounded the horns of legal battle, accusing Snowflake of pumping up its demand forecasts and engaging in discounting debaucheries that painted an unsustainable picture of growth pre-IPO. The class actions are casting long shadows, with claims that such missteps have left investors skating on thin ice, nursing financial wounds as the stock took a significant nosedive following disappointing financial revelations and trimmed sails on future growth forecasts. Today's trifecta of tribulations around Snowflake serves as a gripping reminder of the high-wire act that is tech investing, where predictions, performance, and legal parries paint a picture as complex as it is compelling. Stay tuned as we dive deeper into these stories, considering the implications for Snowflake and its shareholders. In the bustling world of tech, Apple, the titan known for its innovative prowess, found itself under the spotlight yet again with a mixed bag of news and insightful reflections from its past. At its core, the stories of the day shed light on Apple's managerial philosophy under the legendary Steve Jobs, along with presenting the somewhat bumpy road ahead due to slowing iPhone sales, which have raised eyebrows and invoked analysis from market watchers. Steve Jobs, Apple's co-founder and charismatic former CEO, once famously highlighted the pitfalls of hiring professional management that didn't quite grasp the essence of Apple's innovative spirit. In a revealing trip down memory lane, Jobs critiqued the early managerial hires as bozos, who excelled in management but fell short when it came to actual contributions. He emphasized the importance of promoting those who initially didn't aspire to be managers, yet showed exceptional skills, a philosophy attributing to Apple's sharp eye for internal talent. Jobs delineated three essential attributes for sound company management: promoting skilled contributors, hiring judiciously, and fostering a collaborative environment, all underpinned by a shared vision for the company. However, the current landscape brings challenges to the Apple empire, forecasted by analysts foreseeing a decline in sales and earnings in 2024, marking it as a potential first since 2016. A specific note of concern is the demand softening in China, a crucial market for Apple, coupled with increasing competition from domestic brands like Huawei and Xiaomi. This scenario is compounded by the anticipated dip in iPhone orders, affecting the overall revenue projections. Despite these hurdles, Apple's resilience and adaptability stand out. Amid speculation, its stock, as contrasted with peers, displays potential for long-term investment backed by its expansive ecosystem, innovative forays such as the Apple Vision Pro, and a robust services segment, delineating a picture of Apple that, despite occasional fluctuations, hints at enduring strength and growth potential. The dual narrative of reflecting on its foundational principles while navigating contemporary challenges encapsulates Apple's journey, showcasing its unwavering pursuit of excellence and innovation in the ever-evolving tech landscape. Today, the cyber streets were buzzing with stories about Palo Alto Networks, an influence undeniably cast by the shockwaves of bearish options trading sentiments and the looming dread of class action lawsuits. Here's the breakdown. First off, Benzinga highlighted an unusually bearish stance among deep-pocketed investors towards Palo Alto Networks, as detected through options trading. Their tech whizzes noticed 27 unexpected options trades, revealing a tilt towards bearish sentiment, 70% bearish to be exact, against a smaller portion of bullish outlooks. This trading pattern hinted at possible insider anticipation of upcoming turbulence or shifts in the company's stock performance, forcing the tech community to keep a close eye on any forthcoming impacts. On the legal front, things got even more intense. Lawsuits are piling up against Palo Alto Networks, with allegations thick enough to slice. Specifically, charges laid out in a securities class action lawsuit allege misleading statements and omissions regarding the company's market share, growth sustainability, and AI initiatives during a defined class period from August 18, 2023 to February 20, 2024. The bombshell dropped after the company announced lowered billings and revenue guidance, paired with an earnings call confession detailing a strategic shift and a significant shortfall in U.S. federal business. The aftermath? A stock price plummet of over 28%, a tough hit for any entity in the NASDAQ scene. Two heavyweight law firms, Bernstein Liebard LLP and Levi and Korsinski LLP, have stepped into the ring, reminding investors of the ticking clock to file a lead plaintiff motion. With billions recovered for clients in the past, these announcements heighten anticipation of potentially hefty settlements or court battles ahead. In the vibrant and volatile world of tech stocks, such developments serve as critical plot twists, shaping the narrative around a leading cybersecurity firm such as Palo Alto Networks. As we watch the company navigating through these tumultuous waters, one can't help but ponder over the broader implications for market sentiments and the evolving cybersecurity sector. But let's flip the script over to you, the informed viewers. What's your take on Palo Alto Networks' current plight? Do you see a rough patch ahead, or maybe a silver lining in these clouded skies? Dive into the comments below, share your insights, predictions, or any other thoughts stirring in that tech-savvy mind of yours. Your interaction fuels the dialogue and drives deeper analysis, so don't hold back. Today's market sentiment is a complex tapestry woven from strands of legal battles, corporate maneuvers to address regulatory pressures, strategic shifts, and investor skepticism, painting a picture of an industry at a pivotal crossroads. Google's settlement to delete billions of data records and revamp its privacy practices casts a dual shadow of relief and scrutiny across the tech giant. This monumental decision underscores a heightened focus on digital privacy and regulatory compliance, yet it highlights the ongoing challenges Google faces against a backdrop of antitrust and privacy concerns. The market may interpret this as Google taking responsible steps forward, but also as a signal of potentially costly regulatory encumbrances down the line. Microsoft's strategic move to unbundle Teams from its Office suite globally, driven by antitrust concerns, reflects a tech behemoth's proactive strategy to navigate regulatory landscapes. While signaling an open embrace for competition and flexibility for users, it could also be seen as an acknowledgement of the tightening grip of global antitrust regulators on tech corporations. This narrative might imbue the market with cautious optimism regarding Microsoft's adaptability, but also with vigilance about future antitrust challenges. Snowflake wrestles with investor skepticism mirrored in bearish options activity, a sell rating from analysts citing disconnect with generative AI expectations, and looming class action lawsuits alleging misleading growth forecasts. These events merge into a storm front of concern and wariness, suggesting that investor and market sentiment could sway toward apprehension about Snowflake's immediate prospects amidst fears of overvaluation and litigation risks. Apple's story arc, bending from a retrospection of Steve Jobs' management philosophy to analyst concerns over slowing iPhone sales, emphasizes endurance interlaced with vulnerability. The challenges Apple faces in key markets and the competitive pressures hint at potential headwinds, yet the narrative of resilient innovation suggests an underlying confidence in Apple's long-term growth trajectory. Palo Alto Networks finds itself navigating through bearish options trading sentiment and class action lawsuits alleging misrepresentation, illustrating the cybersecurity giant ensnared in litigation uncertainties and potential shifts in market share dynamics. This could precipitate a cautious or wary sentiment among investors, observing how Palo Alto Networks will tackle these legal and financial challenges ahead. Overall, today's market sentiment exemplifies a cautious optimism tinged with a spectrum of uncertainties, spanning regulatory, legal, and competitive arenas. Investors and stakeholders are likely measuring the trade-offs between innovational leaps and the potential pitfalls of regulatory and litigative hurdles, indicating an intensely watchful and discerning stance towards the tech industry's unfolding narratives. Digging into the tumultuous landscape painted by today's tech news, I'd lean into the narrative surrounding Snowflake and share a personal perspective. Of course, not without emphasizing the utmost importance of conducting your own research and considering your investment strategy. Given the threefold drama unfurling around Snowflake, starting with a valley of bearish bets marked by unusual options activity, an analyst cutting down its rating to sell based on a perceived lag in hopping onto the generative AI frenzy, and the looming clouds of class action lawsuits alleging overly rosy demand forecasts pre-IPO, there's a tempest brewing that might give potential investors pause. The stock took a nosedive following these developments, indicating a significant dip in investor confidence and potentially pointing towards a bumpy road ahead. Would I buy, sell, or hold? In this scenario, if I already held Snowflake stocks, I'd seriously consider holding, but with an ever-watchful eye on the horizon. Here's why. Generative AI and market reaction. The critic concerning Snowflake's integration or leverage of generative AI is critical. Yet, technological landscapes evolve swiftly, and today's laggard can be tomorrow's leader with the right strategic pivot. Keeping a keen eye on Snowflake's upcoming initiatives in response to this feedback could provide essential cues on whether they're gearing up to close the gap. Legal and financial uncertainties. The class action lawsuits raise eyebrows and warrant caution. Legal challenges can be lengthy, costly, and tarnish a company's reputation. However, they can also lead to settlements without severely impacting the company's long-term operations. Diligently following the developments on this front would be prudent. Bearish bets. The bearish sentiment, especially from seasoned investors, suggests anticipation of further dips. However, market sentiment can sometimes be a knee-jerk reaction to immediate challenges, overlooking a company's potential for rebound and long-term growth. Given these considerations, my stance veers towards holding, but not without taking this opportunity to closely monitor Snowflake's responses to these challenges and adapt my strategy as necessary. This cautious but flexible approach might allow capitalizing on potential rebounds or strategic successes that Snowflake could achieve once the dust settles. Always do your due diligence and consider consulting with a financial advisor to tailor decisions to your financial goals and risk tolerance. Today's tech market has been a whirlwind of critical updates, strategic shifts, and legal eagles circling some of the biggest names in the biz. From Google's landmark privacy settlement to Microsoft unbundling Teams from Office, and amidst Snowflake's chilly forecast against a background of legal thunder, the tech landscape is nothing short of dynamic. Not forgetting Apple's blend of historical reflection and future challenge navigation, alongside Palo Alto Networks, navigating through troubled legal waters. Each of these narratives stands as a testament to the fast-paced and ever-evolving nature of the tech industry, where companies continuously maneuver through the complexities of legal, competitive, and market pressures. It's a stark reminder of the vigilance required to both secure and sustain leadership in the fiercely competitive tech sector. So did today's analysis spark any thoughts or opinions you'd like to share? Hit that like button, subscribe to stay updated with the latest tech news, and don't hesitate to share this video with others who crave their daily dose of tech insights. Let's keep the conversation going in the comments below, and I promise to bring even more engaging content your way tomorrow. Stay tuned, and let's continue to navigate the intriguing world of technology together.